Ever wondered how financial instruments work? How do these complex terms, options, futures, derivatives, that you often hear in the finance world function? Well, sit back, relax, and prepare for an enlightening journey into the world of finance. First up on our list is options. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset or security at a specified price within a specified time frame. Think of it as a reservation at a restaurant. You reserve a table, but you aren't obligated to show up. You pay a small fee for this, right? And if you decide not to go, all you lose is that fee. In financial terms, this fee is called a premium. The predetermined price at which you can buy or sell is known as the strike price. Next, we have futures. A futures contract is a standardized agreement to buy or sell a particular asset or commodity at a predetermined price at a specific future date. Unlike options, futures are not about rights but obligations. If you've ever pre-ordered a book that's set to release in the future, you've essentially entered a futures contract. You agree to buy the book at a specific price on a certain date. Just like the book, in a futures contract, both parties are obliged to fulfill the contract on the agreed date. Lastly, there's derivatives. A derivative is a financial security with a value that is reliant upon, or derived from, an underlying asset or group of assets. The derivative itself is a contract between two or more parties, and its price is determined by fluctuations in the underlying asset. Imagine a concert ticket. Its price will vary depending on the popularity of the band, the location of the concert, and other factors. Similarly, a derivative's price changes based on the underlying asset, which could be stocks, bonds, commodities, currencies, interest rates, or market indexes. Now, let's recap what we've learned. Options are contracts that give the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified time frame. Futures, on the other hand, are contracts that obligate the buyer and seller to transact an asset at a predetermined price at a specific future date. And finally, derivatives are financial securities whose value is derived from an underlying asset or group of assets. Remember, these financial instruments are not just jargon tossed around in the finance world. They represent agreements and contracts that have real-world implications. They are tools that investors use to hedge risks, speculate on future price movements, and potentially earn a return on their investments. So the next time you hear the terms options, futures, and derivatives, you'll know exactly what they mean and how they operate in the financial world. They're not as complex as they might have seemed, right? Understanding these concepts is a step towards financial literacy, and that's a journey worth embarking on. Keep learning and keep growing.